If time is money, as we've always been taught, then why do we waste so much of it in the bank? It's a question we often ask ourselves, with a certain irony, almost like a modern mantra. The relationship between time and finance is indeed one of the most complex, and at times, paradoxical, relationships in our contemporary existence. This intimate and indissoluble bond should be the engine of unparalleled efficiency. Yet, at the heart of the banking and financial sector lies a glaring contradiction. It's a paradox worth exploring, with a bitter smile and a healthy dose of reflection. The world of finance has internalized the concept that time is money in a way that few other sectors can match. It's not just a popular saying, but an operational truth, an inescapable dogma that permeates every transaction, every decision, every strategy. Here, every passing second isn't just a ticking clock, but a potential opportunity or an imminent risk. Every moment can translate directly into profit or loss in an arena where markets never sleep. Speed is the most valuable currency, and its management is the supreme art. It's an environment where inertia is a cardinal sin, and promptness is a virtue. But there's an even more fascinating aspect of this relationship: the power of compound interest. Here, time doesn't simply flow linearly, but becomes an active multiplier, a catalyst for exponential growth. It's the silent engine that fuels financial expansion, transforming small sums into fortunes, and the future into a richer present. This principle isn't just a mathematical formula, it's the very soul of financial growth. It's the key element that gives the sector its dynamism, its ability to generate value from nothing, or almost nothing. Without time, compound interest would be a mere abstraction, but with it, it becomes an unstoppable force. And here we come to the heart of our paradox, an irony that can't help but bring a smile, albeit a slightly forced one. While numbers and investments in the financial world grow at a dizzying pace, driven by a transaction speed that defies imagination, the reality for the average customer is quite different. Money, it seems, has wings, but we, its owners, are condemned to crawl. Numbers multiply, markets react in milliseconds, and fortunes are made and unmade with the blink of an eye. It's a frenetic ballet of algorithms and capital, where every fraction of a second counts. Speed is the undisputed queen, and efficiency is its faithful squire. Then there's our experience, that of mere mortals who dare to interact with this glittering universe. Customers regularly face waits that seem to defy the laws of physics. Endless lines, forms to fill out with the patience of a Tibetan monk, and, of course, the epic call center experience. Who hasn't spent up to 45 minutes waiting to speak to an operator, listening to elevator music that seems to be testing the limits of their sanity? It's a rite of passage, a baptism of fire for every bank customer. A wait that sometimes seems longer than an entire workday. This discrepancy is the real joke. On the one hand, time flies for financial assets and transactions, an unstoppable whirlwind of opportunities and movements. On the other, time freezes for individuals trying to access those services, an eternity of waiting and bureaucracy. It's as if money exists in an accelerated time dimension, while we are stuck in another, slowed down, almost immobile one. The future, we're told, promises unprecedented optimization. The advent of increasingly sophisticated algorithms and artificial intelligence are set to further streamline financial processes. An era of robotic efficiency is on the horizon, where every transaction will be seamless, rapid, and hopefully flawless. Banks, with almost evangelical enthusiasm, are already telling us about ambitious plans. Investment automation is expected with intelligent systems that will manage our portfolios with surgical precision. Efforts are underway to streamline operational procedures, eliminating unnecessary steps and reducing the margin for human error. All of this, in theory, should free up resources and accelerate every aspect of the service. But here arises the question that gnaws at every customer's mind: will all this optimization extend to us too? Will it really reduce our wait times, or will we still be relegated to a temporal limbo while money continues its unbridled run? The implication, unfortunately, is that the current focus may not prioritize the customer experience with the same urgency as it optimizes profits. It's a question of priorities, of implicit values. If time is money, does our time have the same value as their money? Or is there an unspoken hierarchy where capital's time is infinitely more valuable than human time? The future will tell us whether this promise of efficiency will truly be inclusive, or whether it will remain a privilege reserved only for those who pull the strings of the financial game. If time is money, then every moment of our lives possesses intrinsic value and implicit value. It's not just a metaphor, but a profound truth that invites us to reflect on our existence. Every breath, every thought, every action has a cost and a benefit, an investment and a return. But who determines the interest rate on our existence? Who establishes the value of every moment we live, of every choice we make? There is no global market for life's time, nor an algorithm that calculates its return. It is a valuation that escapes financial logic, despite being in some ways its root. Banks, with their market logic, are guided by financial metrics, balance sheets, and profit projections. For them, value is quantifiable, measurable, and always profit-oriented. Time is a resource to be exploited, optimized, and monetized. Individuals, on the other hand, value time through personal choices, priorities, and aspirations. For us, time is experience, connection, growth, and sometimes simply rest. It is a finite, non-renewable resource, and its value is often inestimable, far beyond any monetary calculation. These two very different perspectives collide and intersect in the paradox we are exploring. Time is money, yes, but money is not all time. And the value of a moment can be much more profound than any balance sheet could ever express. It's time to rethink the value of time, going beyond its reduction to a simple financial measure. Time is money is an ancient saying, but its echo in banking jargon pushes us to look deeper. True wealth doesn't reside in bank accounts, nor is it measured in markets, but in less visible and more human spaces. The greatest capital lies in how we live every moment of our lives, and how we invest it in experiences, relationships, and personal growth. It is the richness of our days, the depth of our connections, the joy of our discoveries. This is the wealth that no bank can safeguard and no compound interest can multiply. Time in finance is swift, cold, mathematical, a relentless sequence of numbers and transactions. It's an abstract entity, devoid of emotion, moving with the precision of a Swiss watch but without the warmth of a heart. It's time used to generate more money, in an endless cycle. True wealth, however, lies in the fullness of human experience. It lies in the time spent with those we love, in the passions we pursue, in the challenges we overcome, in moments of quiet and contemplation. It is qualitative, not quantitative, time that enriches the soul and gives meaning to existence. Every moment passes, time flows inexorably, but evolution, true evolution, remains eternal. It is not just technological or financial progress, but an inner growth, a greater awareness of the profound value of every moment. It is an invitation to live fully, to invest in our time wisely, recognizing that its true currency is not gold, but life itself.